Good day to Dr. Mara. Our group's name is Keith, and today we are going to present about the financial assets. Our group members have Goh Kong Ling, Ho Chun Yao, Fignon Lim Yuan Sin, Tam Mao Ting, Su Jiawei, and Liu Tini. Hey, my name is Su Jiawei, and today I will present about the meaning of financial assets. Financial assets had included in Malaysia Financial Reporting Standards, which are MFRS 7 Financial Instrument about the disclosure, MFRS 9 Financial Instrument, and MFRS 132 Financial Instrument regarding to their presentation. A financial asset is a liquid asset that gets its value from a contractual right or ownership claim. Contractual right arising from past transactions that provide future economic benefit to an entity and result in a financial liability or equity of another entity. Financial assets do not necessarily have inherent physical worth or even a physical form. Rather, their value reflects factors of supply and demand in the marketplace in which they trade, as well as the degree of risk they carry. Most assets are categorized as real, financial, or intangible. Financial assets are in the between of the other two assets. Financial assets may seem intangible with only the stated value on a piece of paper, such as a dollar bill or a listing on a computer screen. What the paper or listing represents though is a claim of ownership of an entity, like a public company or contractual rights to payments, let's say the interest income from a bond. According to MFRS 132, paragraph 11, the example of financial assets are cash, equity instrument of another entity, contract settled in the entity's own equity instruments, contractual rights to receive cash or another financial assets, and also the contractual right to exchange financial instrument with another entity in favorable conditions. Now, I will explain how to recognize the financial assets. There are three situations of recognition of financial assets. First of all is the contract for purchase inventory on credit. Let's say Company A had purchased inventory from Company B on credit, so Company A will become the trade receivable to Company B, while Company B will become the trade payable to Company A. So the financial asset had recognized at the trade receivable of Company B, while the trade payable of Company A is the financial liability. The second situation is the investment of bond in Company B. So let's say Company A had purchased bonds from Company B, so it will be recognized as financial assets, while Company B, who issued the bonds to Company A, will be recognized as financial liability. Thirdly is the share issued by Company A. Let's say the Company A had issued share, so it is the equity to them, while Company B had made the investment on Company A by purchasing their share, then it will be recognized as financial assets. However, it will follow different standard according to percentage of holding rights. For examples, if it is holding 50% or above of the rights, it will follow MFRS 10. If it is holding 20% to 50% rights, it will follow MFRS 128. And if it is holding 20% and below of the rights, it will follow MFRS 9. According to MFRS 9, paragraph 3.1, it says that an entity should recognize financial assets or financial liabilities in their balance sheets when and only if the entity becomes the one of the party in instrument contractual. Thank you.
Good day, Dr. Mara. I am Goh Kong Ling and I'll be presenting on classification of financial assets. Under MFRS 9, each financial asset is classified into three main categories that I will be presenting later on in my next slide. The classification is determined by both the entity's business model for managing the financial asset, which is the Business Model Test, BMT, and also the contractual cash flow characteristics of the financial asset, Cash Flow Characteristics Test, CCT. Under BMT, there are three main categories, which is hold to collect and sell, and also trade. Under hold to collect business model, the objective is to hold the asset to collect the contractual cash flows. It need not hold all of those instruments until maturity. Sales of financial assets can occur or can be expected to occur in the future. As for hold to collect and sell business model, the objective is to hold to collect contractual cash flows and also sell the financial assets. Entities' key management personnel have already made the decision that both collecting contractual cash flows and selling financial assets are integral to achieving the objective of the business model, instead of being only incidental to it. As for trade model, it is a residual category with the objective of realizing cash flows through the sale of assets. Therefore, there is an active buying and selling involved. Under the contractual cash flow test, CCT, it is comprising of solely payments of principal and interest, which is the SPPI. Principal is the fair value of the financial asset at the initial recognition. However, interest is typically the compensation for the time value of money and also the credit risk that one party have to bear due to the loss for another party. Alright, as for the next slide, as I've said previously, financial assets are categorized into three main categories, which is amortized cost (ACM), fair value through other comprehensive income (FVTOCI), fair value through profit or loss. Under ACM method, we can only recognize it under amortization cost if both criteria are met for BMT and CCT. Under BMT, it has to meet the criteria of hold to collect. The asset is held to collect for its contractual cash flows, and CCT for the SPPI. The asset's contractual cash flows represents solely payments of principal and interest. As for fair value through other comprehensive income, we can only recognize if both criteria are met. BMT, where it is hold to collect and sell. The objective is achieved both by collecting contractual cash flows and selling financial assets, and also meet the criteria of CCT. The asset's contractual cash flows represent SPPI. For fair value through profit or loss, it is a residual category as said previously. We were put into the categories of FVTPL where it failed the criteria of BMT and also CCT. It do not need to meet any criteria of fair value through other comprehensive income and also amortized cost. The classification is for the purpose of subsequent measurement because subsequent measurement is on a mixed model basis.
Good day everyone, my name is Tan Mao Ting. I will further elaborate on measurement for investment in debt instrument (IID). When the initial recognition criteria is met, the entity should initially measure the financial asset at fair value of the purchase consideration paid to acquire the financial asset plus direct transaction costs that are directly attributable to the acquisition. In the case of assets are classified as fair value through profit or loss, the transaction costs are recognized in the income statement where the cost of acquisition are expensed. Transaction costs include fees and commission paid to agents, brokers, and dealers, levies by regulatory agencies, securities exchanges, and transfer of taxes and duties. However, transaction costs do not include debt premiums or discount, financing costs, or internal administrative or holding costs. When a financial asset is measured at fair value, then fair value is measured at each year in accordance with MFRS 13 fair value measurement by applying the three levels of fair value hierarchy. Under amortization cost, the interest received, impairment, and foreign exchange gain or loss will be recognized to the statement of profit or losses, and the interest will be recognized by using effective interest rate. All the fair value changes will be ignored as these assets are measured at amortized cost over time. On derecognition, gain or loss in disposal, and cumulative gain or loss in other comprehensive income, it must be recognized to the profit or loss. One example of a financial asset that will fail the test in amortization cost is a convertible bond because it will fail the SPPI criteria. While there is receipt of the nominal rate of interest payable by the bond issuer and the bond will be converted into share or cash at a later date, the cash flows are affected by the fact that the bondholder has a choice to make at some later date, either to receive share or cash at the time the bond is redeemed. For fair value through other comprehensive income, interest received, impairment, and foreign exchange gain or loss will be recognized to the statement of profit or loss, and the interest income will be recognized by using effective interest method. All the fair value changes will be recognized to other comprehensive income, which is cumulative in equity. On derecognition gain or loss in disposal, it must be recognized to the profit or loss, whereas for cumulative gain or loss in other comprehensive income, it will be reclassified to profit or losses from other comprehensive income. All other debt instruments will be measured at fair value through profit or losses. Under this classification, there will be no interest to be collected. All fair value changes, derecognition, and cumulative gain or loss in other comprehensive income will be recognized to profit or loss. Under investment in debt instrument, reclassification between fair value through profit and loss and amortization cost is permitted when an entity changes its business model, but this situation is less frequent. Prospective adjustment should be carried out from the reclassification date without restating any previously recognized gains, losses, or interest. This reclassification of financial assets requires annual review for evidence of possible impairment, and if there is evidence, there must be an impairment review. Any impairment identified must be charged to the profits or loss in full immediately. That's all from me. Thank you.
My name is Fion Lim Yuan Sin, and I would like to present about measurement on equity instruments. Equity instruments are likely to be shares that have been purchased in a company, but not enough to give the investor significant influence, control, or joint control. Equity instruments can be classified as fair value through other comprehensive income. It is important to note that this designation must be made on acquisition and cannot be treated as FVTPL. This is only an option if the equity investment is intended to be a long-term investment. As for fair value through profit or loss, it's a default treatment for equity investment, where transaction costs such as broker fees are expensed and not capitalized within the initial cost of the asset. Subsequently, the investment is revalued to fair value at each year end. For the changes in fair value, they are recognized in profit or loss as FVTPL, except for those equity investments for which the entity has elected to present value changes in other comprehensive income as FVTOCI. As for dividend, if an equity investment is not held for trading, an entity can make an irrevocable election at initial recognition to measure it at FVTOCI, with only dividend income recognized in profit or loss.
Good day everyone, I'm Liu Tini and I'm here to present the derecognition of the financial assets. It is the removal of previously recognized asset or liability from the balance sheet. Asset will be derecognized if either the entity's contractual rights to the asset's cash flow have expired or when the asset has been transferred to the third party along with the risks and rewards of ownership. So basically the derecognition principle is that an entity should derecognize a financial asset when it no longer qualifies as an asset of the entity. Next, we can clearly see this decision tree has shown the summary of criteria for the derecognition. First of all, as I mentioned in the previous slide, we need to determine whether the entity's rights to the cash flows from the asset has expired. If the contractual rights to the cash flows from the financial asset have expired or are forfeited, then the entity derecognizes the asset. But if it is not expired, then we shall proceed to the next criteria, which concern whether the entity has transferred its right to receive the cash flows to another party. The transfer will then have to be assessed in step 4 to determine whether it meets the derecognition criteria. Whereas an entity that still retains its rights to receive cash flows from asset may assume an obligation to pay the cash flows from the asset. The asset will then carry out the derecognition test in the following steps. In contrast, if the entity does not assume the obligation to pay, then the asset will continue to recognize in the financial position of the entity. Furthermore, the asset will be derecognized if substantially all the risks and rewards have been transferred. But if the risks and rewards from the assets are not transferred, then we will move on to the next step. In step 5, if the transferor's exposure has not changed substantially as a result of the transfer, mean it has retained all the risks and rewards of ownership of asset and does not derecognize it. If the entity has not retained all the risks and the rewards, then it carries out the test on the next criteria. When an entity neither transfers nor retains substantial all the risks and rewards of the ownership, then we can determine whether it has retained the control of the asset. So, if an entity has lost control, it will derecognize the asset, whereas if an entity has retained the control, it will continue to recognize the asset to the extent of its continuing involvement. It is part of the year-end closing procedure that may include a step to review all fixed assets currently on the books to see if any should be derecognized. That's all for the derecognitions of financial assets. Thank you.
Selamat sejahtera Dr. Mara. My name is Ho Chun Yao. I will present the topic impairment of financial asset. Before this, we use MFRS 139 that use current income loss model. Now it's replaced by MFRS 9, uses expected credit loss, which is ECL model. The general rules of MFRS 9 is an entity shall recognize a loss allowance for expected credit loss. My first part is about impairment testing. Financial asset require impairment test under MFRS 9. For the debt investment, impairment testing under MFRS 9 is required for debt investment, which is including hybrid instrument measured at amortized cost, which is AC, or FVOCI, and no impairment testing required for those instruments measured at FVTPL. For equity investment, no impairment testing is required for equity investment, which are all measured at FVOCI or FVTPL. For the lease receivable, although scoped out of MFRS 9, the impairment and the recognition requirement apply to lease receivable and recognized by a lessor. My second part is about MFRS 9 impairment approach. They have two types of approach, which is general approach and simplified approach. I will explain about general approach. The general approach have three steps of recognition of ECL, which is step 1 performing state, step 2 underperforming, and step 3 non-performing. These three steps then determine the amount of impairment to be recognized. For the step 1, an initial recognition of a financial asset. For this state, credit risk has not increased significantly, and entity recognize a loss allowance equal to 12 months expected credit loss. These are the credit loss that are expected to result from default events that are possible within 12 months from the entity reporting debt. The transition from step 1 to step 2 is based on the nature of a significant increase in credit risk over the remaining life of the instrument. My first example, possible lifestyle expected credit loss indicator is significant change in the operating result or financial position of the borrower. And second example is increase in credit risk of other financial instrument of the same borrower. The transition step 2 to step 3 is they have objective evidence of impairment as the reporting debt and recognize lifetime ECL. The step 3 indicator that an asset is credit impaired would include observable data is the disappearance of an active market for the financial asset because of financial difficulty. And my second example is the borrower enter bankruptcy. My last part is about measurement of impairment. Extra credit loss formula is exposure at default multiplied by loss given default and multiplied by probability of default. ECL is the probability weighted estimate of credit loss, for example, the present value of all cash shortfall over the expected life of a financial instrument. The concept is particularly important in the context of MFRS 9. That's all. Thank you.